What's up, everybody? Austin here. You can see it on the screen. We are up $9,500 this week for almost 18% on the week. Portfolio value, we have broken 63,800. We're building a portfolio from 10K to a million right here on YouTube. Transparency every step of the way. Like the video and subscribe if you like that content. We started the portfolio on February 15th, 2022. We're down $7,000 since then, but that's about 10% up from here, maybe 12% up from here, and we're in positive territory. What are the stocks we own? We talk about this a lot, and we'll go back to weekly just to show you how much they're up on the week. Snowflake, Crowdstrike, Datadog, Gitlab, Tesla, The Trade Desk, MongoDB, Cloudflare, and RKLB. By no means, so I recommend anybody just own 7 stocks. ETFs are great, index funds are great. I talk about them on this channel. If you want dividend exposure, SCHD. If you want S&P 500 exposure, VOO, those are great for people. I like investing in growth stocks and following growth stocks, which is a lot of what I talk about on this channel. But that's certainly not the only option. What happened in the market this week? And this is just skimming the market news. What I want to point out is I don't react to weekly and daily market news. I look for companies I want to own for the long term, and my goal is to own them for years and years while I follow the company and make sure that things are going well. So this is just today. S&P 500 is up huge, 2.7%. The Dow's up. The NASDAQ is up. There's a bunch of bad news coming out, and you would think that the market should be going down on bad news. Well, the market has dropped a lot, and what tends to happen is that people get overexcited, the market goes up, then it sells off, people get way too scared, and the market eventually bottoms and comes back. It's a natural human thing. And in my opinion, the worst thing we can do is try to trade in and out and time it, because it's impossible. Because if I would have sold out of my stocks and missed this week, then my question for myself is, when do I get back in? And if I'm a long-term investor trying to do things other than just stare at the market and invest all day, why would I waste time trading in and out, paying taxes, all that stuff, when I could be using my time productively for other things like doing my job, getting a raise, whatever, making sweet, awesome YouTube videos. You should like this video and subscribe. This is why we invest long-term. This is just the S&P 500, and it's since 1993. I talk about this a lot. It's super boring. If you don't like it, that's fine. But I think super boring sometimes is a great way to think about investing. Since 1993, the S&P 500 is up almost 800%. That's with the 2000 bust. That's with the Great Financial Crisis, 2007, 2008. That's with that drop. That's with the COVID drop. That's with this recent drop. And if we look, there's been multiple times over that period where the S&P 500 has dropped 40%. It dropped down 26, 29% during COVID. It dropped down 21% just recently. Those things happen, and in my opinion, they're impossible to time for us mere mortal human beings. And so I don't even try to. What I try to do is find great growth stocks and just own them for the long term. And I'm going to talk about some of the metrics I look at to evaluate stocks. And I go deeper in this in my email newsletter, austin.substack.com. It's linked below. But these are the things I look at. Revenue growth estimate for the current fiscal year. So that's looking forward a little bit. Gross profit margin. How much does a company keep from every sale it makes? Enterprise value to revenues. That's one way to value companies. Profit margin. SG&A expense. Now we're thinking about how much of a percentage of revenue are the company's expenses. If we look, these are ranked by expected revenue growth rate for the current fiscal year. These are the companies I own. RKLB, 239%. Very risky company. They still have a small revenue base. They're in the space industry. Tons of upside, but tons of risk. Snowflake, 66%. Gitlab, 59%. Tesla, 59% on a crazy amount of revenue. Datadog, 57%. Crowdstrike, 51%. Cloudflare, net, 46%. MongoDB, 36%. I think it's actually going to be higher than that. The Trade Desk, 33%. And so, of course, there's more that goes into investing in a stock than just revenue growth. But if we look at the performance of stocks over time, those that can have revenue growth 20 to 30% or higher for, we're talking 10, 15, 20 years, companies that have done this have been companies like Google, Facebook, Amazon. So we look for companies that can sustain high revenue growth and improve the margins over time. The companies I own generally aren't profitable right now, but what I want to see is that they're making progress towards profitability. Here's some watch list stocks that I keep. And I don't own any of these, but these are ones I keep an eye on, and they might be good ideas for other people out there. SentinelOne, which is they kind of compete with CrowdStrike. They're in the security space. 98% revenue growth expected for the current year. AMD, 60%. This one's high on my watch list. These are ranked by revenue growth, so not necessarily by my interest in the company. Zscaler, 60%. Monday, 59%. Mercado Libre, 49%. Upstart, 48%. Okta, 39%. Twilio, HubSpot, Atlassian, Shopify, ServiceNow, Nvidia, Expel, Axon Mobile, Salesforce, Microsoft, Google, Amazon, Zoom, Facebook or Meta, and then Coinbase. And so again, those are just ideas. They're stocks that I follow. I think in general, they're pretty good stocks. I don't own them, and I'm not ready to say that I'm going to own them, but just stocks that I think are, more than just meme stocks. That doesn't necessarily mean they're good investments. Some of the ones that are towards the top of my watch list are AMD. They just have such an awesome track record. Mercado Libre is trading at a pretty much a cheaper EV to revenue forward than it has in the last, I think, decade or so. But I have some questions around Latin America, which is kind of where they're headquartered, and then where a lot of their sales come from, as well as just what e-commerce demand looks like. And so that's kind of why I'm hesitating to pull the trigger there. Upstart is actually really interesting to me, but it's dangerous just because if we're going to be in a tightened lending environment, their model might suffer temporarily, but I think long term could be a really interesting opportunity there. Atlassian I really like, but for the revenue growth to be trading at a price EV to revenue of 17 forward is just a little bit too expensive for me compared to other things that I can own. Shopify, again, kind of same situation as Mercado Libre, although it's US based. Just trying to figure out where do they settle and where does demand go? Do they lose a lot of the merchants they signed up from COVID, and what does that look like? I think, again, long term, Shopify is probably in a great situation. ServiceNow, another incredible stock, 26% expected revenue growth with EV to revenue of just about 13. Nvidia is another one. I've been waiting for this thing to come down. It's been really expensive. It's getting down to where it's interesting to me, and you can't argue with their tracker. I have some questions. I want to see what happens with all this crypto craziness and the drops in the market, how that impacts Nvidia. Might get a better opportunity there. Axon, they do tasers and kind of security devices for law enforcement, and they're getting into other industries. They've got a lot of competitive advantage, and we don't have to worry about a ton of competition for them. So interesting potential opportunity. And then, of course, Salesforce, Microsoft, Google, people know those. Facebook's interesting. It's about as hated as it's ever been, trading super cheap. But what does growth look like? And then is this metaverse and AR and VR stuff, what is all that spend going to look like, and what does demand look like there? I'm not sure. And so, yeah, just the last thing I'll cover real quick in this video, and then we'll get out of here, is just what the EV to revenues of the forward EV to revenues of the companies I own look like. So Snowflake's pretty expensive at about 20, but I've talked about it a lot. I think they have one of the most significant long-term growth opportunities of the companies I own. That's why I'm willing to own it when it has a higher EV to revenue. Datadog is up at 19, kind of same ballpark as Snowflake, but Datadog is an incredibly efficient company with cash flow, and they have a pretty short road to profitability, in my opinion. Crowdstrike at 17 with pretty high revenue growth, so I'm okay with that. Gitlab 17, again, high expected revenue growth. Cloudflare 16, MongoDB 16, The Trade Desk 13. It trades a little high considering expected revenue growth, but they're a very efficient company. They're profitable. They have a huge moat, and they're definitely a leader. Tesla down to 8, 60% revenue growth. People argue Tesla's worth 0, and people argue Tesla's worth $1 million. I think I want to own shares. I'm going to keep it a reasonable percentage of my portfolio and invest in that upside and invest in the innovation in Elon Musk. And then Rocket Lab, again, I talk about this one a lot. Super risky, probably the most upside of any stock that I own, but also the most risk. And so that's really it for today. That's a valuation update. I wrote an email newsletter to all our subscribers this morning. So if you're interested in that, just check out the first link in the subscription. Hope you had a great week. Hope you're taking care of yourself. And I'm not trying to time the market. I'm trying to own great stocks and continue owning them. And that's my strategy.